Good afternoon, everyone. Thank you so much for your patience. We're happy you could join us today, and we do have a great program lined up for you. A few things before we get started. This is being recorded, and it will be made available after the session. As well, if you have any questions for today's speakers, please put them into the questions box. I will be coming back at the end of the session to ask those that have come through so far. So today is brought to you by our great members at Fox Rothschild. And the topic is From Venture Capital to Private Equity, Franchise Investments and Trends. And our representative from Fox Rothschild is on the phone today. So I am going to kick it over now to Liz. Liz, can you hear us?
Yes, I can. Can you hear me all right?
Yep, you're good to go. All right, I'll kick it over to you now.
Okay, welcome everybody. Sorry about being on the phone, but there's been some technical difficulties. So, but hopefully everybody else is on there. So I will be cueing the PowerPoint orally. My name is Elizabeth Siggety. I am the chair of Fox Rothschild's Emerging Companies and Venture Capital practice. I am also the founder and past chair of the franchise practice at Fox Rothschild. We are a national law firm with 27 offices across the country and are very proud of our franchise practice. I'm going to go ahead and let the amazing panelists introduce themselves, starting with Satya.
Thanks, Liz, and thank you all for joining here. Satya Panuru, I'm a general partner with New Spring Franchise. New Spring Franchise is one of the 5 strategies within New Spring Capital, a $2.5 billion private equity firm that goes back about 20 years. We launched the strategy. I launched the strategy in partnership along with my partner Pat Segru about 2 years ago. And we focus exclusively on investing in multi-unit consumer service businesses with less than $5 million of EBITDA. And in every situation, we are focused on partnering with exceptional founders and management teams that have great brands and customer value propositions where we think in partnership with those teams we can grow the businesses substantially. And we've been delighted over the last year to make a couple of investments. The biggest of which is in partnership with Vanessa, who is on the call here, in Blow Blow Dry Bar, and we've been delighted and have been honored to partner with her and her team.
Thank you. For the next panelist, Bill Stewart, unfortunately, is not feeling well, so his partner Bernard Markey is with us today. Bernard, can you introduce yourself?
Certainly. Thank you, Liz. I've been investing in private companies since 1988. Navigator was formed in 1999, and in 2003, we led the buyout of CK Franchising, which was the franchisor of Comfort Keepers, the largest in-home non-medical senior care franchisor in the country. We owned that for about 4.5 years and had a very successful experience improving the quality of management and the support to franchisees and more than doubling the size of the business. And coming out of that, decided we would invest our own funds with a focus on franchising going forward. Since then, we have invested growth capital in Smashburger and K9 Resorts, which is a dog daycare and boarding franchise concept. We started First Light Home Care, which is a in-home senior care company that we put together in 2009. We now have close to $200 million in system sales with almost 200 franchisees. And we also participated in the buyout of Crestcom, which is an executive education franchisor. We seek fantastic management teams with whom we can be long-term partners. We are investing our own capital, so we don't have an exit time horizon. We can be a multi-decade partner in these businesses. In the case of First Light Home Care, we've already been involved in the company for a dozen years and expect to be owners of it for decades to come. We are moderately active as board members and happy to get involved with early stage franchisors right up through buyouts of more mature franchisors.
Thank you. Ed, can you introduce yourself?
Thanks, Liz. Ed Texera. I've been in the franchise industry about 40 years. and got my start in the home healthcare sector. We were only one of two companies that were franchised. The other was Interim. And we actually did about $500 million in home healthcare services, including skilled nursing. I've done a lot of international franchising, currently in the process of co-authoring a textbook on franchising, which hopefully will get published by the end of the year. A franchise grade started about 6 or 7 years ago as a portal where franchise candidates or people interested in investing in a franchise could take a look and evaluate various opportunities. We like to think of ourselves as sort of a Moody's for potential franchisees. We grade franchise opportunities from A to D. We have about 500 variables that we use, and we extract that data and that information from thousands of FTDs that we've accumulated over the last number of years. So I'm here to provide some intelligence, I'd like to say, some metrics on the franchise industry. So those of us who are interested from an investment standpoint can get a sense of which sectors are leading the crowd, so to speak, which categories are the most vibrant and robust, and basically provide a little bit of a leg up on which franchise sectors seem to provide the best growth opportunities based upon the metrics that we have.
Thank you, Ed. Vanessa?
Hi, Vanessa Jakobsen. I'm the CEO of Blow Dry Bar, the company that Satya mentioned earlier. I'm also a partner in this business and a founder alongside my husband, Ari Jakobsen, and our business partner, Paul Spindler, and looking forward to representing the franchisors and company owners' viewpoint here today.
Yes, and that is very important, so thank you for joining us. So we're gonna, next slide. So we are going to try to get through a lot in a very short period of time, try to be as efficient as possible. So we are covering both private equity buyouts and venture capital minority growth investments, which are really different beasts, but also have some similar considerations. The panel has invested in everything from bare bones startup franchisors to advanced private equity acquisitions. So we have a wealth of and range of experience here. To set the scene, as many have probably heard, there's tons of dry powder out there. Dry powder being uncalled capital, capital that various fronts from venture capital to private equity have raised but have not yet invested, and it's been on the rise. And also deal activity is at a quick pace. Private equity in the first half of 2021 of almost $457 billion is 2/3 of the deal value recorded in 2020. So it is increasing even despite the pandemic and everything else that's going on. Private equity firms, the number of brands grown and the interest in that sector has grown in recent years, both in smaller chains, larger chains, groups, franchise, private equity groups buying complementary industry brands. But on the other hand, the pandemic has changed things around a little bit, and some brands needing investment are going out to private equity or venture capital who might not have expected to do so, and others have flourished in the pandemic. Next slide. So here's for the lawyers on the phone, here's the first CLE code. So write this down. Hopefully you can see it on the screen as well. It is Venture 2021. So the word Venture, VENTURE 2021. So take a note of that. There's going to be another code later. So I'm going to turn this over to Ed for a talk about the landscape, what's out there. Ed?
Thank you.
Slide.
Thanks, Liz. What we did was we took a look at franchise sector growth. Most firms, whether it's us, Frandata, the IFA, typically use the 10 major sectors when presenting data on franchising. So we took a look at the growth in franchise units from 2015 to 2019. So this is pre-pandemic for the 10 sectors. And as you can see, the leader of the pack, and it's not surprising, is personal services, which includes home care, children's services, et cetera, health and fitness. So they led the pack with 27.4%. And QSR, which is, they represent the largest number of units in the franchise universe. They were second, and that was followed by commercial and residential services. And by the way, commercial services have recently, in the last few years, based on our activity, has really started to increase in terms of interest on the part of prospective franchisees. And then we follow up with business services, et cetera. So, you can take a look at that. And by the way, if anyone needs any of this data afterwards, you can always shoot me an email. Next slide, please. This is a composition of the franchise industry and the brands by the number of units. And it's some people are a bit surprised when they see this. 60% of the franchise brands have less than 50 units, and 47% have 27 units or less. And of course, as you can see, 73% have less than 100 units. I believe there's like 4% have more than 500 units. So the franchise industry, whatever the actual count is, and some will tell you it's 2,500 brands, 3,000 brands, whatever the number is, the preponderance of franchise brands are comprised of systems that have 50 units or less. So there's a tremendous amount of opportunity. I always like to say that the emerging brands, those with 25 units or less, there's some real nuggets in there. But sometimes a franchise, the entrepreneur that's out of the program, either exhausts most of their capital building the franchise, or they lack the acumen or skills to be able to bring it to the next level. So there's some good opportunities in the 50 units or less category. The next slide, please. We broke down the 20 top franchise categories, and we took 5-year growth, and we made sure we kept it down as those that had 500 franchise units or less. And you can see the categories. Now, within each sector, obviously, there's categories. So education, entertainment, sports training, they're all part of personal services. Pest control is going to be part of residential and commercial services. So you see property management, they led the pack with 60%, and it works its way down. Pharmacy, 48%, and wellness and nutrition, 41% now. And that's really increased in activity. And once again, that's going to include not only fitness programs, but also home care services. You've got a couple of franchise concepts that have drop-in medical clinics, et cetera. So if we go to the next slide, you'll see the next 10 specialty stores, children's services, which continue to be a very strong and vibrant sector, repairs and general maintenance, marketing, there's fitness and gym, and home care is down at the bottom, but 18% isn't anything to sneeze at, particularly when you look at the amount of franchise units in that category. There's probably about 65 or 70 brands in the home care sector, most of which provide custodial or senior care services, with only a few providing what we would call skilled nursing services. Next slide. What we found is that when you look at growing brands, and this has been pretty consistent over the last number of years, some of the patterns that you're going to find is that the growing brands, the successful brands, they're going to stick to concentric growth or clustered growth. You're not going to have a franchisee in one area and another one 100 miles away. So that way they can saturate a particular market and they can gain brand recognition much more quickly. They're going to avoid certain markets. They're not going to be driven by, having a candidate that might have great qualifications, but wants to franchise in a market that doesn't provide the right opportunities or potential for growth. And they're going to obviously, based on their acumen, their skills, they're going to have advanced branding opportunities. So they're going to be able to capitalize on their concept that has certain attributes that are going to be able to make that brand a lot more recognizable versus some competitors. The brands that don't do as well, they have very unpredictable development strategies. I go back a long time ago, and I can recall we have someone in, they're interested in a franchise. We had no one near that area. The franchise development salesperson that worked for me would plead to do the deal, but we had no one to support that individual. Moreover, this was in the home health care sector. So we didn't want to have one franchisee in, let's say, Dallas and another one in Des Moines, Iowa. So it took a lot of self-discipline to avoid fragmented development growth. But unfortunately, those franchise brands that get involved in that could quite easily run into problems. They also are going to have, and it's not unusual, it's just common sense, they're going to have a lack of brand recognition. They're just not going to be recognized and highly visible in terms of particular markets. Next slide.
Thank you.
CLE code 2. Okay.
I'll go from here, Ed. Thank you.
You're welcome.
So yes, the second CLE code, please write this down. It should be on your screen, is Equity 23. That's EQUITY 23. Everybody get their pencils out. We will not be repeating these codes, by the way. Equity 23. All right, we're going to move into the panel discussion area now. And this will be led by Bernard, Satya, and Vanessa. So we have the first thing we want to find out from our venture capital and PE colleagues here, and Bernard, I'll ask you first, is why would a venture capital or private equity firm choose to invest in the franchise industry versus non-franchised companies?
Sure. Thank you, Liz. Happy to answer this. I think first, before we get into the business attributes of the franchising model, from a personal perspective, the opportunity to be part of growing a business and helping people who want to be entrepreneurs become successful entrepreneurs is incredibly energizing to myself and my partners. And that's an important part of the reason why we're excited about investing in franchising. The financial side of the business is equally, if not even more attractive. As the franchise system broadens and grows and there are more franchisees, the businesses have no concentration of customers because it's spread among so many franchisees. They generally have, if you're supporting the franchisees well and growing the system, very good growth attributes. There are no capital expenditures to speak of. And over time, as the brand matures, EBITDA margins can grow to be 50% of revenues or higher. And I guess lastly, especially for the funds investing in the franchising industry that seek an exit multiples can easily run into the teens, and I'm sure in some cases higher for emerging brands that have critical mass. And those are multiples of EBITDA. I'd also say the industry, as it's matured, has attracted ever more professional talent, giving us as investors the opportunity to partner with great quality business people.
So Satya, why did NewSpring decide to get into this recently?
Sure. So NewSpring Franchise was launched to focus on investing in multi-unit consumer service companies in large markets with disproportionate growth relative to the broader economy due to fundamental consumer demographic and consumer behavior trends. So if you look at the underlying sectors with a lot of franchising, which Ed just walked through, personal care, restaurants, et cetera, you find really large markets, lots of growth, and lots of fragmentation. And so that we fundamentally really want to be investing behind market tailwinds. As it relates to franchising within that segment of multi-unit consumer service, I think Bernard hit on a number of them, some of the obvious draws, the capital efficiency of the model, not needing the same type of balance sheet compared to a company-owned unit development model. And additionally, you have significantly diminished unit level operational complexity, which allows for those EBITDA margins to get up as high as Bernard alluded to. And so those are some of the various things as we go out and really think about what companies we want to invest in and some of the traits there. We sort of fundamentally look at four big traits, I'd say. One is, looking to invest in those sectors that have a lot of growth and lots of tailwinds that fundamentally can't be displaced by technology. So hence we like a lot of service-oriented businesses. Second, we're really looking for great brands with really strong customer value propositions. Third, we want to invest in concepts with attractive unit economics and a track record of portability and scalability. And lastly, but really the most important, is we're looking to form great partnerships with founders and management teams with alignment around the strategy and goals for that business. And so as you think about some of those characteristics, Blow Dry Bar hit on every one of those, with the most important being we felt like we were partnering with an exceptional founder and CEO in Vanessa, with someone that had the talent, the track record, and the capability to be running and overseeing and building a business that's going to be 3, 4, 5 times the size of what we anticipated it being.
Thank you. And Vanessa, from your side, I know that maybe you're in the unique proposition of not really looking for investment, but what is the reason that you decided to move ahead?
Yeah, you're right, Liz. So we had not been looking for a partner. We were a small group of sort of family and friends, investors, and had been since the beginning of our history. We always take calls from private equity as they've come our way. We felt it was always important that we understood what the landscape looked like and what opportunities there were available to us, but we certainly were not looking seriously. I'll be honest and say that it was the uncertainty of COVID that led us to seriously consider our options last year. Again, not proactively, reactively. New Spring was one of 2 companies that had approached us, both of which we went pretty far in conversations with before deciding that New Spring was the right partner. And so for us, it was really about coming out of COVID with great strength. We knew we were in the fortunate position of being able to self-fund and weather the storm, but we finally concluded, after much soul searching, that we would get to where we wanted to be: bigger, faster, sooner, with New Spring on board, with both their capital and their expertise.
And when you were talking to the different investors, what qualities of an investor were important to you?
The New Spring guys were quite amused by my request that I have the opportunity to speak with other CEOs that they work with, so that I could really understand their style. I think for those of you looking at investing or doing deals with entrepreneur-led companies, you'll probably appreciate or maybe need to appreciate that entrepreneurs tend to not want to be told what to do very much. So really wanting to make sure that we had the right partners who, as Satya has described, respected where we were at, were impressed by what we achieved, not only by our corporate team, but also by our franchisees as a system. So we were looking really for a partner that was going to come in and support what we were doing, rather than come in and try to impact what we were doing in a way that would really shift direction and be counter to the vision that we were on track towards.
You sort of dated a little bit.
A little bit, that's right. That's right. And
so,
then
yeah.
some checks with some of their other dates or partners.
So, Bernard, what does an investor consider when trying to value a franchise company?
I think you have to start with whether we're looking at a relatively mature franchisor or an earlier stage business. The more mature franchisor is probably a buyout candidate, presuming it has millions of dollars a year in EBITDA. And the considerations there would be how large the system is relative to the ultimate potential of the system. If you have 200 units open, the value would be different if ultimately you could only have 300 versus 1,000. What the quality of the management team is, and how the economics are of the underlying business model of the franchisees. We usually must start there and see that the franchisees have a compelling business model, because if they're not making money, you have nothing. The franchisor in the long term cannot be successful without successful franchisees. And as I alluded to earlier, we are very long-term investors, often holding investments for a multi-decade time horizon. If it's an earlier stage franchisee seeking growth equity, we are still looking for a compelling and proven economic model for the franchisee. In our case, it's probably a couple dozen typically open units that are performing well. We got involved in First Light Home Care at a much earlier stage because we've been in the senior care business before, and in Canine Resorts a bit earlier. But people generally want to see that the economic model is working well and know that the people with whom they're partnering, such as Vanessa and her partner and her husband, are people with whom they can work over the long term to build a business and share common values and how to do so.
Hear, hear. The franchisee economics is obviously very, very important. But what about, oh, next slide. I'm trying to move through these quickly. So Satya, what are the, on the other hand, what are the pitfalls? What are the hidden liabilities? What do you worry about?
Yeah, well, certainly with any type of investment, you know, the risk is in the unknown. And so certainly, you know, a big piece of the diligence that we are doing is, as Bernard alluded to, is really understanding what the franchisee economics look like and the health of the existing franchisee system. Because again, if the existing franchisees aren't happy and they're not making money, then you know the ability to grow is quite limited, and you're probably setting yourself up for failure. And so that's at the very top of everything that we look at, and it's really one of the things that attracted us the most to Blow and Vanessa and her team was when you go look at the relationship that Vanessa has built with her franchisees, and you go talk to those franchisees and their views of Vanessa and the team at Blow. It really tells you all you need to know, especially during what is hopefully a once in a lifetime issue with the pandemic and a closure rate like that. You have a substantial amount of the system literally mandated to close down, and the response from between Vanessa and her franchisees is that of collaboration and working together. And those franchisees speaking so highly of her during that period really tells you all you need to know about the strength and the quality of the business and the system, and probably more importantly, the management team.
Yes, clearly collaboration and communication is key to a healthy system. Bernard, how about a mix of the franchise and company-owned locations? There's systems that are 50-50, some that have no company-owned locations. Does that matter in your evaluation, or what do you look for?
There are certain business models that lend themselves to being company-owned or having a portion of the system be company-owned, and others that do not. In the senior care business, we are in a importantly local networking business. We bring a fair amount of business to the franchisees through national alliances, but we really find those businesses are most successful with an in-market entrepreneur on the ground, and it's a bit harder to run that kind of an operation in a corporate structure remotely. In contrast, both at Smashburger and Canine Resorts, we have very successfully had corporate-owned locations. And in the case of Canine Resorts, we expect ultimately that could be as many as a third of our Canine Resorts will be corporate-owned. We will tend to cluster those in strong geographic markets, that is markets with strong demographics, and have larger resorts there. The ability to obtain capital at a reasonable cost is obviously critical to growing a corporate-owned location model. But there is no hard and fast rule in our view of it should be 50% or 10% or 0, or well, if you're 100, you're not a franchisor. So.
Well said. Vanessa, turning back to the company side, when considering an investment or when trying to get ready for investment, what would you advise potential franchise companies to do?
Well, you certainly have to have things in order, don't you? So we had always undertaken audits. We're based in Canada. Most of our units are in the US, but we have here as well. So we've got two separate entities. So we had two separate sets of books, so to speak. And in the US, we would do annual audits. Here in Canada, we would do annual review engagements, which is an equivalent just below audit level. So really, we had everything well buttoned up. We had our corporate minute books in order. We had our systems in order. So I would say any company that imagines one day wanting to have some sort of transactional exit, make sure that your company records and systems are in solid place. I think Satya would agree, it made things very easy through the diligence stage. All the information that the NewSpring team was looking for was readily available. Any questions that were asked through the diligence process were readily answered. So having access to all that information, having it well in order is key.
Yes, and as an attorney, I would completely agree with you. We work with a lot of emerging franchise systems, and sometimes it's really surprising how out of order things are. They can't find all their franchise agreements signed. They can't find the receipts for the disclosure. You have to worry about supply chain and vendor issues, and also the strength of your trademark and your intellectual property, making sure that it's been appropriately guarded. I mean, obviously I could go on, but those are a few things.
You know, Liz, sorry to interrupt, add one other thing. You know, we're in a fortunate position because my husband is in the world of investment, so he understands how this all works. He's a lawyer by profession or by education, and my business partner Paul is also a lawyer by education. So I would say to other franchisors, if you don't have that skill or a resource on your team, look for it externally. Make sure you've got folks available to you who can help you get things in order as they need to be.
That's a great tip. Absolutely. So moving on to the elephant in the room, the pandemic. Satya, you did mention how you were, Blow Dry was, because of the relationships with the franchisees, was able to get through the pandemic well. Is there anything else you think that's changed or people should consider because of what's been going on?
Yeah, I mean, you know, I think if anything, it gave us even more confidence in some of the sectors and the business models that we wanted to be investing into. You know, I'll take personal care as an example. Obviously, at the depths of the pandemic, going back about 16 months ago, when most personal care service providers were forced to entirely shut down due to various mandates. You know, we all did what we had to do, you know, personally included. I went on Amazon and ordered some clippers, and all of a sudden my wife was now a hair cutter unintentionally. And I can tell you, if my experience was like anyone else's, both my wife and I wanted to remove ourselves from that relationship of her providing haircuts. And probably when I went back into to go get my haircut, I had a renewed appreciation for the customer value proposition of that, and I was probably willing to pay a whole lot more for that. And I think in many services, people have found that more and more. So if anything, I think we found renewed and in greater confidence in some of the business models that we want to be investing into.
Yes, thank you. I think we're going to talk about governance after Ed. Ed, would you like to move to the next slide and talk about some of the importance of franchisee relations, etc.?
Thanks, Liz. By the way, pardon my Boston accent. I survived 5 years in Louisville and 35 years in New York. So in any event, yeah, I think probably one of the most important factors, in addition to any financial information and KPIs, et cetera, is the relationship between the franchisees and and their franchisor. And I think when anyone looks to invest in a franchise, or when a franchisor looks to recruit or engage an investor, it's very important that they have a very strong relationship. And there's 3 areas that I mentioned: high satisfaction levels. I think in addition to having your financial house in order, having all of your franchise documentation in order, your acknowledgement of receipts properly dated and executed, you should have some track record of some performance satisfaction surveys, whether you use a third party or you do it in-house. That's very, very important. And that's a prerequisite. I don't care whether you're looking for an investor or not, because it's going to tell you where your strengths are and any weaknesses you may have. The other thing is the opinions of the executive team. That's obviously very important to consider. And the third factor is going to be the appetite for growth. I mean, there are obviously some franchisors that are going to be, satisfied with a certain level of growth. There's others are going to be, maybe they're going to have some unrealistic expectations, just like prospective franchisee that can't wait to open 10 locations and they haven't even opened their first location yet. So that can happen on both, both sides. I also want to make one comment about the pandemic. There's one thing that shouldn't be forgotten. The viability of the franchise model, it helped to survive the pandemic in a lot of cases, because built into that were royalties, ad fund contributions, etc., that the savvy franchisors could give some relief to enable their franchisees to survive and keep their head above water. So to me, that's a tremendous testament to the franchise business model in terms of how it could survive. And most of them have survived something as devastating as a pandemic. The next slide. Here's some red flags that I don't really need this to tell you, anyone that's been in the industry a long time. These are some red flags to look for if you're conducting any kind of due diligence. And once again, if you're on the franchise or side, you better make sure you don't have any of these issues. Sold but not open. We found a lot of FTDs. They have the most unrealistic sold but not open data in their item 20. And you look back and they've probably achieved about 10% of that. That to me is always a red signal of selling very aggressively. And they've been franchisors in the past that have done that. And they have a preponderance of franchise agreements they've had executed, and the franchisee never gets to open them. Then they end up with problems, litigation, etc. Item 20, errors. And that goes back to, believe it or not, we did an audit of item 20s, and you can't even imagine the mistakes we found in terms of eliminations, in terms of other data that's in the 3 tables that are in item 20. FTD changes, there's FTDs out there. I swear to God, I don't know who did the FTD, but in the document, but it had to be, the brother-in-law who's a real estate attorney, because some of them have more errors and mistakes, and it's only going to hurt not only the franchisor, but it's going to be a red flag for anyone that's looking to invest in that concept. What's the background of the executives? Do they have the potential, the experience, the wherewithal of being able to lead this franchise into the next level of growth, so to speak? That's very important, and I'm sure anyone that's looking to make an investment in a franchise brand is going to be very, very careful about the quality of the leadership of that franchise. And last but not least, another red flag is no item 19. Now, I know of one franchise that's extremely successful. I even spoke to the founder about this, and that's Jersey Mike's. Believe it or not, they have no item 19. Does anyone want to question their success? I doubt it. They have a reason for not having an item 19, and that is to encourage and to almost force their prospective franchisees to do a very, very thorough due diligence. But for the typical franchisor, you want to have an item 19, and you don't want to have something that just has average revenues. You want to have maybe about 4 or 5 key metrics in that item 19. But if you can give a prospective franchisee the opportunity to be able to do a proper due diligence, to do a cash flow, to do a pro forma income statement, as well as to give the potential investor the opportunity to be able to identify some good metrics, that validate the fact that this is a good franchise and that the franchisees are successful. I think that was the last slide, but you can try one more. Next slide. That's for you. That's not for me.
Okay, yes, back to me. So I'm going to return to some governance and transition issues. Bernard, can you comment on some of the considerations you may have when purchasing or investing in a franchise system?
I'd be happy to, Liz. You know, in so many cases, we're coming in as the first outside investor the entrepreneur founder ever had. And they owned 100% of the business before we joined forces with them. And they were used to making all the decisions themselves. And we articulate very clearly in the investment term sheet, as well as the operating agreement of the business that the business operates under going forward, what decisions we will be involved in and the mechanism for making those decisions. Our most important governance mechanism is the board of directors. And most of these companies prior to our investment do not have a board of directors, and we help them constitute one. We are important members on that board along with the founders, and in some cases, some outside investors or others who have great franchising or specific industry experience. And that board, depending upon the stage of development, could meet anywhere from monthly for a very early stage company to quarterly for a more mature business. We get involved with management on a case-by-case basis in a number of other areas, and it might range from helping to identify, recruit, and interview key senior members of the management team. We have extensive experience doing that. If we are developing corporate units, we will be very involved in site selection and helping with financing around those. And there's all kinds of other things that we will work on with management outside of the board meeting, including at times attending discovery days and speaking with very large prospective franchisees. But again, all of this is articulated in the term sheet, and the mechanisms for all of this interaction are codified in the operating agreement so that there really are no surprises. We have extensive discussions about how we will work together before making the investment to ensure that we're all on the same page and our arms are locked as we move forward together to grow the business.
Yes, and this is the control issues and the governance issues are both part of the due diligence and how the business is going to move going forward. And it's very important to have that clarified in the beginning. Next slide should be legal issues. All right, so the next two slides could take half hour, but we are already pretty much in the question and answer. So I'm going to run through these so everybody can get a sense of, on the legal side, what the due diligence issues and structuring issues may be. As everybody knows, the joint employer issues are becoming once again more prevalent. Well, they never went away. And joint liability issues in franchising, whether the employees of the franchisee would be considered employees of the franchisor. There is some new guidance by the Department of Labor, which will loosen up that test. The next thing to look at is compliance with the franchisor's operation standards. Is there consistency across the system, which of course is the hallmark and quality control of a franchise. The next is compliance with franchise regulations. As we all know, some states also have their own regulations and allow for direct claims to be made by franchisees. So we want to make sure that all of those regulations have been well complied with, and also what states they're concentrated in. Some states are a little tougher, like California, than others. Looking at supply chain issues, purchasing arrangements, what the rebates and the revenue from those arrangements would be is very important. Some private equity groups try to leverage efficiencies in the supply chain by buying complementary brands. So administratively and through supply chain and otherwise, they can become more efficient at the top end. Review of the advertising fund. The uses of what are the limits on the use of those funds? Has that been complied with? gift card loyalty programs, are they accepted system-wide? I think Ed already touched on the financial performance representation. In addition to having one, making sure the data underlying those FPRs is solid. And then, of course, indemnification and insurance, both on the franchisor and franchisee side, making sure that the franchisor is well protected. Next slide. So on legal issues, structure of the deal and any M&A transactions, so this would be for PE acquisitions, whether it's an asset or a stock sale. Sometimes the stock sales are slightly more common. In my experience, there's less consents, no need to fire and rehire employees, a little easier to amend the franchise disclosure document than to start from scratch with new audits and everything else. But of course, taking over the liabilities is a risk, and in an asset sale, one has to draft very carefully to make sure all the assets are properly included, especially if you're not taking everything, so that is tricky. The timing of the purchase price, whether it's all paid on day one or whether there are earnouts. Earnouts are something that is very careful. You need to carefully draft, try to make as objective as possible what the milestones are for those earnouts. One big issue is when to tell franchisees whether to go dark on sales. As we all know, especially in a private equity acquisition, it's a material event. And under state laws and other laws, you're supposed to include material events in your FDD when selling a franchise. So one consideration is, will management change? Obviously, if you're selling a franchise to somebody and 2 days later, the entire management changes and it's taken over, that franchisee may well have a claim if they don't like it. So who bears the risk of claims? What is the effect of suspensions in sales? When do you stop sales? Is it at the LOI? Is it when the sale agreement is sold, or do you not stop sales? There's no one answer on this one, but it's something that should be thought about. I think we touched on governance and control issues, looking at side deals when renewals are happening, and all of that. So there is a ton to do. People can think about in the beginning how thorough they want the due diligence to be. If it's a big system, whether you're just going to look at the form franchise agreements, whether you're going to look at every franchise agreement. And that is my very, very quick legal, top-level legal summary. I think we have only 4 or 5 minutes for questions. I unfortunately can't see the questions, so I'm going to turn this back to Kristen to lead.
All right, thank you so much. So we have had a few questions come in. I think I'm going to ask them to the group and then see who can answer them. So we'll start with, what size stake do VC firms typically look for? Is there a minimum percentage by sector, use restrictions or directives for funding? I'm not sure who to point that to. So
that would be Satya or Bernard.
It's probably one of the two. Go ahead, Satya. Why don't you take your crack at it?
Yeah, sure. So, I think, I guess my view is sort of venture capital and private equity have really merged to some degree over the years, and really, fundamentally, I think it's really more, are you a minority investor, a majority investor, and what sort of controls do you need, both economic and governance perspective? And I think that may be sort of a general demarcation between VC and venture capital and private equity. And so from that perspective, I think most venture capital firms tend to be minority investors, maybe investing in rounds, participating with multiple other investors, and a group of folks may be syndicating to have control in a board capacity. Us personally, we tend to be working with emerging brands that tend to be primarily founder-led. And so for us, it's really about the partnership and the alignment with those founders and those management teams. And certainly there's the documentation of it, but outside of the documentation, is there a strategic and personal alignment on the business and how we're going to do that together? And you know, I think it goes back to one of the things we talked about, which is, you know, fundamentally these are in many ways these are marriages that you can't easily extricate yourself from. And so is this someone, or and for both sides, does the founder want to work with that investor on a regular basis, and vice versa? And do you think you're going to work constructively through not just the good times, but the bad times and the challenges that you are going to encounter? And I think those are the big questions to me.
I agree with you that those are the critical questions. And I think on the point of the size of the enterprise, there are private equity firms and venture firms out there for almost every stage of development. We started First Light Home Care from scratch. I don't think there's many firms or groups out there looking to start a franchisor. There's some, but once a system has somewhere in the dozens of franchises and up, there will be different groups of private equity funds that find those attractive. Some private equity funds wouldn't touch a franchisor that has less than $25 million of EBITDA. We would be interested under a lot of circumstances in partnering with a franchisor that still has negative EBITDA. So it's really a matter of matching the private equity firm with the scale of the business. And I think also importantly, finding private equity firms that understand franchising and understand the dynamics of the industry. As I alluded to, we have over 18 years of investing in franchising. So we know it well. There's a lot of people for whom it's the bright new shiny object in the room, and they come rushing in, but they really don't understand the dynamics of the industry. I think they have a lot less value to add to the business.
We did have a few other questions, but I certainly want to be respectful of our speakers' times today. So I will send those questions we didn't get to on to Fox Rothschild. And if you opted in, they can certainly respond and answer that. Or of course, on the screen right here, all of our speakers have been kind enough to give their contact information. So if you'd like to ask your question directly to them, please do so. So on that note, thank you all so much for taking time to attend today. Thank you all so much, Ed, Bernard, Satya, Vanessa, and Liz, for taking time to speak today and provide all of your knowledge. This was really great. To Fox Rothschild, again, thank you so much for your constant support of IFA and sponsorship. Everybody have a great rest of your day and stay safe, stay smart. Bye.
Bye-bye.
Thank you. Bye-bye.